What's going on, fam? Mohamed Randera here today. So what we're going to do is something a little different. We're going to analyze a hypothetical rental property using some easy to do calculations to see whether or not it makes sense to invest in this type of venture. So stay tuned. So today I wanted to do something different. Everyone is always talking about buying investment property. So I thought that we'd look at one today here in Orillia, and then we'll look at some numbers and see if the deal is profitable or not. What we're going to do today is study a method called the four square method. Now, you'll probably see several prominent YouTube real estate personalities refer to this method, and I think it's pretty spot on when analyzing a deal. So you look at the income, you look at expenses, cash flow, and then something called cash on cash, ROI. And ROI stands for return on investment. Now, our sample property today is, let's say, $400,000. It's a 3-bedroom, 2-bathroom duplex. So upstairs you have a 2-bedroom unit with a bathroom and a kitchen, and downstairs you have a 1-bedroom unit with a bathroom and a kitchen. Annual property taxes, just to make it easy, we'll say are $3,000 a year. Now, we know that interest rates are fluctuating a lot as of last year and even going into this year. So just to be safe, let's say a fixed rate of 5% is what we're getting on this property with a 30-year amortization. We also have to factor in the land transfer tax, which is $4,475. $1,000, let's say, for the lawyer fees, title insurance, roughly about $400. And then the other closing costs would be inspection and appraisal, which let's just say are $800. Let's say we're going with the 20% on this property. So that would be $80K, which leaves you with a total mortgage of $320,000. And when you do the math, you can easily do this math even on Realtor.ca in the mortgage calculator. Your total monthly payment is $1,708. So altogether, if you were to put 20% down and invest in this $400,000 property, your total investment would be $86,000, 378. Now, the going rate for a 2-bedroom in Orillia, I'm just doing an average here. I know that it's a bit higher than this, but just to make it easy for calculation, we'll say is $2,000, and a 1-bedroom is roughly about $1,500, right? So that gives us $3,500 in income. So what we're going to do is fill out these 4 boxes you see here, right? You got the income, cash flow, expenses, and cash on cash, ROI. So the income, this is the money that the property generates. Now, in our scenario, based on current rates, we'll go with 2-bedroom, again, going for $2,000, and a 1-bedroom going for $1,500, which gives us a total income of $3,500, right? Now, you can also group other income in there. Let's say you have coin laundry on the property. That's another source of income. Maybe you're renting out a parking spot or a garage. You can always throw that in there. That would all be considered income. But we want to keep this simple. So we're going to assume that the gross income for the month is $3,500. Right now, below here you'll see these are expenses. Expenses are pretty straightforward. These are costs that are incurred in operating a rental property. right? So you have things like property tax, insurance, utilities. If you're covering utilities, there would be an expense. But what I always suggest is get the tenants to pay for their own utilities. This way, they'll be mindful of how they're using electricity, water, natural gas, and so on and so forth. You also have to factor in landscaping and snow removal. In this case, we're going to say that's about $100 a month. Sorry, I skipped this part. Insurance, we said, is $100 a month. Property tax of 250. I always suggest that you also want to factor in from the income money for repairs. So it's always good to set aside some money for these minor repairs. Now you'll see here, I put CapEx, and CapEx stands for capital expenditures, right? So those are major things that you have to do. So for example, a roof needs changing, maybe you have to replace the furnace, maybe you have to repave the driveway. Now you're not going to do these things every month, but it's important that you save for that, right? So for this rental property, let's say every month you're putting aside $120 in your CapEx fund. Now, if you don't plan on managing this property yourself, let's say you live in the GTA or you live in a different city, you can't be bothered to come down to Orillia every month to deal with tenants and tenants issues. You're probably gonna have to hire a property management company. So there are several notable property management companies in the area, and oftentimes most of these companies want about 10% of gross rent, right? So we're setting aside $350, and I know that's on the conservative end, but it's important that you set this aside from your gross income. You also have to factor in vacancy, right? Vacancy is basically, when a unit may not be producing a cash flow for you, right? So maybe a tenant is leaving, maybe you've just moved in and you're looking for tenants. It's important to put aside money for those times that your unit could possibly be vacant. Now, we have a very hot rental market right now. So you might be tempted not to put aside money in your vacancy fund, but I think it's very important to do so. So we're going to put aside $150 for that. And then finally, remember earlier on we did the mortgage calculation. This is going to be your largest cost, which is $1,708. So the total operating cost for this duplex is $2,878. So next, we want to look at cash flow. All you're really doing is taking the income, right? So that's $3,500 a month, and you're minusing it from your total operating cost, which here is $2,878. That leaves you with $622 of positive cash flow, okay? So in this case, this is a profitable rental. Now we want to go and do the cash on cash ROI, which is the cash on cash return on investment. And we want to see what the total return is annually on this investment, right? And this is also very easy for us to calculate. First and foremost, we have to remember our down payment, which was $80,000, right? And we're adding that to the closing costs, right? In this case, again, remember the closing costs, the land transfer tax, the lawyer fees, appraisal, inspection, title insurance. That came out to about $6,378. So our total investment, to purchase this property and get that title in our name was $86,378, right? Now we see that our cash flow is $622. Now to see what your annual return on this is, you'll take your cash flow number, you will multiply it by 12, which gives you your annual cash flow of $7,000 $8,464. Right? Now you have those two numbers. Now what you're going to do is take that annual cash flow amount of 7,464 and you divide it in your total investment that you put in, which is $86,378, right? And then once you get that, you multiply it by 100, which will give you a total of 8.64% return a year. Now compare that to other investments, and that's not really a bad return. And you also have to remember that on top of that, your property will have appreciation over time. So you're getting value there as well, right? So I hope that you found this helpful. And if you're ever interested in learning about cash flow properties in Orillia, be sure to give me a call. My contact information is here, and I'll be happy to chat with you. And if you're interested in getting that investment journey started, remember, it all starts with a conversation. Talk to a professional. That's why we're here. Have a great day. Bye.